What is gold-silver ratio? The gold-silver ratio is the price of gold in ounces of silver. For those focused on dollar profits, it can also be thought of as showing the relative performance of gold versus silver. A rising ratio indicates that gold is outperforming silver, and a falling ratio indicates that silver is outperforming gold. Why is this important? Investors who trade gold bullion, silver bullion, and other precious metals scrutinize the gold to silver ratio as a signal for the right time to buy or sell a particular metal. When the ratio is high, the general consensus is that silver is favored. This is because, relative to the ratio, silver is somewhat cheap. How does this strategy work? When the gold price increases faster than the silver price, the ratio will increase. When the silver price increases faster than the gold price, the ratio will decrease. When the gold price decreases faster than the silver price, the ratio will decrease. When the silver price decreases faster than the gold price, the ratio will increase. Let's suppose you have a $10,000 account and you take a leverage of 5 times. That is, you can trade worth $50,000. As of the 15th of February 2019, the prices of gold and silver were $1,317.14 and $15.67 respectively, according to which the gold-silver ratio stands at 84.05. According to the strategy, we will short $25,000 worth of gold at $1,317.14. That is selling 18.98 ounces of gold at $1,317.14. Simultaneously, we go long $25,000 worth of silver at $15.67. That is buying 1,595.41 ounces of silver at $15.67. What is my risk and reward? Let's assume the ratio comes down to 68. In that case, we would make a profit of 62.6% on $10,000. Conversely, if the ratio increases further to 92, we would make a loss of 23.78% on $10,000. The strategy behind gold-silver ratio is to take advantage of the fact that the spread in the prices is expected to decrease when the ratio is high and is likely to increase when the ratio is low. Historically, this ratio has oscillated from 80 to 85 to 40 to 45, and today is an ideal time to invest in this strategy as the ratio stands around 84.05. Many investors hold gold and silver to hedge against various economic crises. But does this hedge hold up during stock market crashes? To help answer this question, we looked at the past stock market crashes and measured gold and silver's performance during each of them to see if there are any historical tendencies. The following table shows the 8 biggest declines in the S&P 500 since 1976 and how gold and silver prices responded to each. As you can see, gold even climbed in the biggest crash of them all, the 56% decline in the S&P 500 that lasted 2 full years in the early 2000s. It seems clear that we should not assume gold will fall in a stock market crash. The exact opposite has occurred much more often. Trump and trade war. High gold-silver ratio suggests continued pessimism towards precious metals, higher rates and industrial use of silver going down due to the trade war. If the trade war gets worse, then the gold-silver ratio can break the roof and go above 100. And then there are other perennial hotspots. You know the same old, Kim the Missile Man, Brexit and regrets, and any oil shocks which can pull the gold-silver ratio to new highs. After all, historical West is never the real West.